Hey everybody, Smart Silver Stacker here. Hope you're doing well. We've got a lot to talk about today, folks, because the interest on the U.S. national debt has now surged above $1 trillion. According to this report here from Bloomberg, U.S. debt bill rockets past a cool $1 trillion a year. And you can see from that chart there, it's kind of an alarming trend, the way the interest on the national debt is spiking up exponentially. And let me tell you, this number is surging, but it is not done yet. Despite the fact that we have crossed $1 trillion, the interest on the national debt is headed a lot higher. And we're going to talk about why in this video and what that's going to mean for gold and silver. Now, when you look at this chart, again, you can see that it's absolutely going exponential. And it's not just Bloomberg. You can just take a look at the data from the Federal Reserve themselves. Same chart, right? Here, the Federal Reserve. Now, their numbers are a little different than the Bloomberg analysis. They say $981 billion in interest, not just $1 trillion. So, I don't know, $20 billion, give or take. Does it really even matter at this point anymore? The bottom line here is that this is obviously an unsustainable trend. And this number is, again, going much higher. We're going to take a look at some numbers that will show you exactly why this is going to continue to surge. But the national debt, the interest on it is now headed to be the biggest item on the federal budget. It's already higher than the defense budget, according to this most recent data. Very soon it will be exceeding Medicare and Social Security. And this is why you need to get your hands on gold and silver, folks. And we'll be talking more about that as we get through this video. Remember, if you want to buy some gold and silver, make sure you check out sdbullion.com, today's video sponsor right now. New customers can buy gold or silver at spot by visiting sdbullion.com/new. So, let's take a look at some numbers here. First of all, just go to the U.S. debt clock, and you can see not only is the interest on the national debt surging, but the U.S. national debt itself is absolutely exploding. $33.7 trillion. And we just rang up an additional $1 trillion in debt in the last quarter. This quarter and next quarter, we're going to be going another $1.5 trillion into debt. Interest rates are spiking. They're moving up very high. A lot of that has to do with the amount of borrowing. And so all of this new debt that we're taking on is going to be serviced at a much higher rate than the average. And the interest rate on the debt is going to keep moving up. And you can see here, this is what we spend our money on. Defense, war, over $800 billion. Social Security, over $1.3 trillion. Medicare, Medicaid, $1.4 trillion. And pretty soon, just the interest alone is going to exceed all of these other expenses. It's not going to be pretty, folks. Now, Statista, you got a paywall for me here. Shucks. I was going to show you guys a chart from Statista, but apparently you need to set up an account to see this. But the point was that the average interest on the national debt is about 3% right now. Because here's the thing, interest rates have been moving up at a rapid pace. The U.S. 10-year bond now over 4.5%. All these U.S. treasuries, the cost of borrowing for the U.S. government absolutely exploding. But a lot of the outstanding debt is currently being serviced at a lower rate because it was taken on at a time when rates were much lower. The average rate back in 2020 was close to 1%. And, you're seeing this in, for example, all of these banks who are sitting on these low-yielding treasuries, that have been devalued as rates have been moving up. But every month, more of that debt has to be rolled over. So the low-yielding treasury gets matures, it comes to fruition. The government has to borrow more to basically, cover that debt. And so what we're seeing is the interest on the national debt lagging the current rates, but they are continuing to move higher. And pretty soon, in a year or two, we're going to see that rate approaching 4%, 5%. This number is going to continue moving higher. And then, it's going to continue moving higher until it doesn't. And what I mean by that is that, again, I mean, when you see an exponential increase like this, I think we all know this is not a sustainable phenomenon. I mean, think about the interest now. It's over $1 trillion. It took something like 200 years to rack up the first $1 trillion debt. Now the interest on the debt is exceeding $1 trillion. I mean, those are pretty shocking numbers. And just keep in mind, the government doesn't have any money to pay all of this interest with. So how do they get the money to pay this $1 trillion in interest? Well, they got to borrow it. Obviously not sustainable. And, as the government continues to run larger and larger deficits, part of which is just simply to cover the debt service for these enormous obligations, rates will continue to move higher. The more debt that they sell onto the market, the less valuable it becomes, the higher rates go. It's just a supply and demand thing. And do me a favor right now. We got 86 people in the live stream, a little lower than usual, but help smash that like button to help get this information out there, because, I think a lot of people just think that we can continue to borrow indefinitely, but clearly that is not the case. I mean, we're going to find out what the limit is, right? I mean, how high is it? How high do you think the national debt can go? Put a number in the chat. I mean, can it go to 40 trillion? Can it go to 50 trillion? Can it go to 100 trillion? There is a limit. We just don't know what it is yet. But I have a sneaking suspicion that we're going to find out very soon. Now, eventually, the interest on the national debt will have to be brought down. Now, how do you do that? How do they reduce these interest payments? How do they interrupt this exponential trend in this graph? Well, there's really only one way. They got to bring interest rates down, right? And how do they do that? Well, I guess that they could raise taxes and start paying off the debt and being responsible, but I think we all know there's no chance of that occurring. So really the only way they can bring interest rates down is for the Federal Reserve to, one, ease their policy, begin cutting the federal funds rate. But it's going to take more than that. They're going to have to come into the market and buy up large quantities of U.S. debt until the interest rates are brought down. It's a yield curve control. Like the Fed, they can come into the market and they can say, well, we need interest rates to get down to 1%, and they will just buy however much debt they need to bring rates down to that level. But here's the problem with that. Inflation will absolutely run out of control when that occurs. And I think that that's a choice that the Fed is going to be willing to make. When things start to really fall apart, when the consequences of soaring interest costs really begin to manifest themselves. And I mean, we're already there, folks. We just had a bank fail last Friday. We're paying $1 trillion a year in interest now. I mean, how long can this go on? Tax revenues are down. Deficit spending is up. The economy has been hollowed out. To give you an idea of why this, inflation fight that the Fed has been under is ultimately doomed, let's look at this chart, the one we just looked at. Okay, look at what's happening to the interest on the national debt as interest rates soar. Look at that, and then let's think about how we got to this point. Okay, this is the Fed balance sheet. So this represents the first bout of QE in the Great Financial Crisis back in 2008. They bought a little bit of debt there to stimulate things, bring interest rates down. QE infinity, here we go. 2020 crisis, massive QE, massive money printing. More QE infinity. Now, this is how much they have normalized their balance sheet. This represents quantitative tightening, the entirety of it. You can see there's that little spike up when banks started to fail back in March. That's the BTFP, the expansion of the Fed balance sheet to give loans to these failing banks. But look how little they've really brought it down. I mean, we haven't even gotten close to the 2020 levels, let alone pre-pandemic levels. I mean, we're talking about, they've sold maybe $1 trillion worth of treasuries into the market. And look what has happened to the interest cost of servicing the debt. I mean, how high would the interest on the U.S. national debt be if the Fed were to, say, normalize their balance sheet to pre-pandemic levels? I mean, think of what would happen to interest rates. How high do you think they would go? I mean, I can venture a guess. I mean, I think they'd be somewhere around like 19, 20%. That's what Paul Volcker had to do to get inflation under control following the inflationary decade of the 70s. But, obviously, when you've got $33.7 trillion in debt, you cannot sustain interest rates of that level. It's completely impossible. So, when you see debt like this, the reason this all relates to gold and silver, by the way, folks, is that when you see debt like this, $33.7 trillion, there's no way this can ever be paid back except in devalued currency. If you try to normalize the Fed balance sheet at this point, this far into this money printing game, I mean, you see what happens. The interest on this debt begins to absolutely explode. It's completely unsustainable. I had somebody ask me yesterday in a comment, they said, hey, whether silver goes up or silver goes down, by the way, the price of silver up a little bit today. We had a correction in silver yesterday, and I said that I view that as a buying opportunity. When the price of silver drops, I view it as an opportunity to get more of this stuff, because when you look at the debt of this level, there's only one way it can ever be repaid, and that is in devalued currency. And that's why, when silver's at $23, or yesterday it was around $22.50, or silver under $20 or under $25 or under $30, I mean, this is all just an incredibly low price for the price of the precious metals. And this guy in the comments said, well, which is it? Silver goes up, you buy more. Silver goes down, you buy more. Why is it always an opportunity? And the reason is because the national debt is soaring out of control, and the interest on it is soaring out of control. Eventually, something's going to break here. That's the point. We're going to see more bankruptcies. We just had WeWork went bankrupt yesterday or the day before. We're going to see more and more of that. We just had a bank fail on Friday. Maybe the federal government, I guess, can withstand interest payments of any amount, because at the end of the day, they know that they can always just print the money up. They got the Federal Reserve's got their back. But what about businesses? What about regional banks? What about consumers who now, according to the New York Fed's most recent report, have over $1 trillion of credit card debt? The credit card debt went up, I think, 4.8% in the last quarter. What are the interest rates on those credit cards looking like? There's going to come a point here when the pressure on the Fed to ease becomes unsurmountable, and they will sacrifice the dollar and the purchasing power of the dollar in order to prop this system up, because there's absolutely no way they can pay this debt off without the Fed running the printing presses. I mean, that's the bottom line here, and that's why I'm continuing to stack gold and silver. That's why when they move up, down, or sideways, I'm still trying to increase my exposure to hard assets, because, so far we've seen a lot of inflation, right? Speaking of inflation, this is a story that somebody actually sent me, a viewer sent me via email. And you guys can always send me stories at smartsilverstacker@gmail.com if you have something that you think would be interesting to cover in a video. But this is a story I was sent by a viewer about UPS increasing their rates, UPS and FedEx. So FedEx has announced they're going to be hiking their rates, or I'm sorry, UPS has announced a 5.9% increase. FedEx rates are also going up. They say here in this article, this is from parcelindustry.com, so some very exciting reading material here, I'm sure. But very few shippers will actually realize an increase equivalent to 5.9%. Most will be higher. So, while the Fed is out there telling you that inflation is like 3.7%, you're seeing the cost of shipping go up 6%. You're seeing, how many of you out there have a home? Have you seen what's happened to your homeowners insurance policies lately? Give me a 1 in the comments, in the chat, if you've seen a 3.7% increase in the cost of your homeowner's insurance. Give me a 2 if it's been vastly higher than that. I think mine's doubled over the past 2 years, 100% increase. So, inflation continues to rise unabated, and yet, interest rates are still moving up. And this is, the stagflationary hell that is the consequence of the Fed and their manipulation of the economy, their stimulus, their interruption of the business cycle, their refusal to allow the free market to operate as is needed. And ultimately, the consequences of this are going to be a massively devalued US dollar. But investors still seem to be unaware of that. And I got some people in the chat here saying their homeowner's insurance has not changed in a few years. Well, lucky you, mine has gone up quite a bit. And I know a lot of other people are in that same boat. And if you like shipping packages, likely the cost of that is going to go up a lot. And think about this: if you shop on Amazon, what does Amazon do? They give you, free shipping, right? If you have Amazon Prime, or if you buy anything from anybody online, or if UPS ships things for a business that you frequent, if you go to a restaurant and they get their supplies shipped to them via UPS, you're going to be paying higher prices there because all of these expenses, the cost of shipping going up, it's going to work its way through to all other areas of the economy. So much stuff has to get shipped, right? If you drink out of a styrofoam cup at your favorite restaurant, then the cost of that cup getting to the business is going to be higher. They're going to have to charge you more for that soda. It's all, related here. And the Fed ultimately is going to be put into a position where they're forced to decide between, bailing out a federal government whose interest costs are exploding, now paying more in interest than we are on national defense. And keep that in mind, that we've got the biggest defense budget globally by far, dwarfs other nations. So, leader of cola, please, for a cop, right? Just talking to Savage Lee in the chat here. That's funny. Yeah, so, when I see silver at $23, sure, it's catching a bid today, big deal. I would still consider adding to the stack at today's price, as long as the interest on the national debt is soaring and, the economy is coming under pressure. I think it is obvious that the Fed is going to have to try to ease rates here sooner rather than later. Look at this. This is the M2 money supply, according to the Fed. And a lot of this has to do with the Fed's balance sheet and quantitative tightening. But you can see the M2 money supply has been increasing. I think it's actually been increasing since like the 1930s. This chart only goes back to the 1980s, but it absolutely exploded in the pandemic era because of all the stimulus and massive spending. But look, the M2 money supply has actually been shrinking since the Fed got on its inflation fight. It's actually coming down for the first time, I think, in like 70 years, 80 years, something like the first time since the Depression. The M2 money supply is shrinking. But already we are seeing the problems associated with that decline in the money supply. The only way the Fed is going to be able to get inflation under control is if they can decrease this. But can they do that without popping the massive bubble that they've inflated? Absolutely not. That's why we're seeing banks fail. That's why we're seeing WeWork go bankrupt. That's why we're seeing commercial real estate. In the next 2 years, we're going to see $2 trillion of loans maturing in the commercial real estate sector, and delinquencies on debts of all type are on the rise. So, yeah, we've got Douglas in the chat here. This is good info. The small Iowa bank that failed was heavily in trucking loans. Major trucking accounts, receivables, loan companies getting hit. Trucking crash and cost hikes are going to take several institutions down. Yeah, and that's exactly the point. All of this is intertwined in this economy. Just about everybody has too much debt, whether it's trucking companies, whether it is consumers, whether it is small businesses, large corporations, governments. Everybody is with debt up to their eyeballs, leveraged up to the hilt. And that's why interest rates rising is such a huge problem. And of course, the Fed hiking rates absolutely will destroy the economy and bring about a massive economic crisis. But as long as we're still running, deficits to the tune of $1 trillion a quarter, or over the next 2 quarters is going to be $1.5 trillion, there's no way inflation is going to come under control. Think of all the money that is being borrowed from the future and spent into the economy of today, and the inflationary effects that is going to have. This is a huge problem, folks. It's not looking good. And as the interest rates continue to rise, and as the U.S. national debt continues to get rolled over at these higher rates, we are going to see even higher costs for servicing the U.S. national debt. It was Janet Yellen who told us, what was it, like a year or two ago in congressional testimony, that we didn't even need to worry about the national debt. No, you don't have to worry about the debt. All you have to worry about is the cost of servicing it. And she said, and now rates are low. Well, how's that working out, Janet? Are rates still low? No, I mean, if you want to worry about the cost of servicing the national debt, when do you start to worry about it? I mean, look at that. Look at that exponential spike up, and it's not done. It is going to continue to accelerate to the upside. Eventually, the cost of servicing the debt will be the biggest item on the national debt. So, how long can we do that? Can we afford $2 trillion in interest payments, $3 trillion in interest payments? Eventually, something's going to break here because, I mean, ultimately, you get to the point where the national debt will exceed tax revenues, or the interest on the national debt will exceed tax revenues. And think about that. At that point, all of your tax revenue goes towards servicing the debt. How do you pay for the massive government? Well, you've got to borrow all the money to run the government, all the money for putting all those carrier strike groups all around the world, all the money to pay for all of the entitlements that the government has accrued, all the money to pay for, all of the health care that the government has promised to pay for. There's no way this is sustainable. And, why do gold and silver remain low in light of this? That's kind of another thing people ask, like, well, if this is all true, why is the price of gold and silver so low? Well, how many people do you know who are concerned about the interest cost of servicing the national debt? They don't really advertise this stuff on the mainstream media. And listen, when you start having your friends and family, the ones who look at you funny when you start talking about the problems with the national debt and inflation, when they start telling you that you have to be worried about the interest cost of the national debt, that's probably when it's going to be too late to get your hands on gold and silver, because that's when all of a sudden everybody's going to wake up and have this, oh crap moment where, whoops, we're holding a bunch of worthless fiat paper that is guaranteed to be rapidly devalued. I mean, it already is being rapidly devalued. It's like the vast majority, the normalcy bias crowd, the normalcy folks, they go out and they buy gasoline and they buy groceries, and they see that their grocery bill, has like doubled. They see that all of the expenses that they have to accrue massively exceed the official inflation rate. But the Fed tells them, well, inflation's 3.7%. Don't worry about it. And they say, okay, everything's fine. I guess this guy Powell has got everything under control. But yeah, they don't, folks. They're obviously not in control of this. Things are getting out of hand. And again, the Fed is in a position now where they just have a choice to make. They have a choice to make whether they sacrifice the US dollar on the altar of inflation, or they allow the entire system to lock up in a massive liquidity and credit crisis. And who knows? I mean, I don't have a crystal ball. Maybe that will have to happen before the Fed eases and they begin printing. Maybe there will be a crisis. I mean, that's usually what will give the Fed cover to do things like print trillions and trillions of dollars and buy up government debt. It's not like the Fed is necessarily going to get ahead of this thing. We might see everything break and, the price of many assets collapse. You could see, banks failing, cascading failures. But I think that sooner rather than later, the Fed will do what it can to get ahead of that. They gave us a hint back in March. I mean, they didn't take much time to launch the BTFP program, the Bank Term Funding Program, to bail out all the insolvent banks and take those, worthless or devaluing U.S. Treasuries onto their balance sheet. The BTFP, which, by the way, remains at a record high level. So I think that when the cracks really start to show and we see a huge credit crisis looming, the Fed is not going to wait for things to really fall, because I think they know that, this time around, people are beginning to get a little bit wise to what's going on here. And it's all a confidence game. You got to remember that. This is all just a confidence game. And the Fed, I mean, they basically believe this. They believe that inflation is just caused by expectations. Powell basically told us as much in the latest FOMC press conference. And he says, everything's fine because consumer expectations of inflation in the future remain low. But, I mean, how long will that be the case? How long can the Fed jawbone consumers and investors into believing that inflation is going to remain low? Not very long, I don't think. And, they're going to have to do what they can to instill confidence in the system and expect the price of precious metals, once the Fed eases, and, I don't know if easing will just be cutting rates. I don't know if it means they're going to get back into these markets and start buying up debt. I expect that that will be the case. I think there will be more QE, but that's just kind of a gut feeling. I mean, we've just needed it the past two times around. In 2008 and 2020, the Fed had to get into the market and buy debt. And all those problems still exist, by the way. They were just papered over back then, except the problem is now, they're so much worse and the debt is so much bigger. And, we're witnessing a much worse geopolitical situation. You got everybody dumping U.S. dollars and U.S. debt around the world basically right now. I mean, some of our allies may be picking up debt, but the two biggest holders at China dumping U.S. treasuries. You got Japan doing stimulus over there. They've got their currency, the yen, devaluing, so they may end up selling more U.S. treasuries as well. And we're going to continue to see the cost of servicing the U.S. national debt exploding. We are at 81 likes, by the way, 210 people watching. I want to say a big thank you to all of you who are tuning in right now. If we could get 19 more likes, we get over 100 before the end of the live stream, I would be thrilled with that. That would really be great. So please, if you haven't done it yet, smash that like button. Help get this information out there into the algorithm, because people need to wake up. People need to get ready. If you know anything about exponential stuff, and I'm not a mathematician or an expert on this, but when things start moving like this, that's usually an indication that you're getting near the end game. So look at the slow rate of increase and then boom, spiking up. And again, the average rate on the national debt right now is around 3%. That is going to continue moving higher and higher, and the debt is going to continue getting bigger and bigger. The deficit spending isn't ending anytime soon. And so that means that we're going to reach a critical mass of interest payments here in the very near future. And I don't know what'll be the first thing to break. I mean, it probably won't be the interest on the U.S. national debt. This is just like a canary in the coal mine, because again, the government can always just borrow more. They can always sustain higher interest rates. But, those of us out here, consumers, businesses, banks, we don't have that luxury. And so, this should be very alarming to us, because this is just an indication of what's happening with debt across the board. And there's a lot of debt, folks. $1 trillion of credit cards, $1.5 trillion of student debt. Everybody's just levered up to the hilt, and this whole thing is going to fall apart unless the Fed starts easing. And when that happens, well, it probably will be too late to get gold and silver, at least anywhere near these prices. So that's why I'm continuing to stack. We don't buy gold and silver for it to go up tomorrow or next month, or, for a quick profit. Like, this stuff is insurance against a systemic collapse, but a systemic collapse is becoming much, much more likely. And, a lot of people will say, well, I've been hearing this for years. And it's like, well, yeah, I mean, the writing's been on the wall to anybody who's been paying attention for years. And now we're just getting closer and closer to this terminal event. No one knows when it's going to arrive. Nobody can tell you on this date or that date that, things will become unsustainable and the Fed's going to reverse course and ease policy. I mean, of course, if you knew the day that was going to happen, you would probably become a billionaire, right? Because you'd be able to time your bets. You could use a tremendous amount of leverage. You could take advantage of that information, but nobody knows. But the one thing that I do know is that this is unsustainable. This cannot go on for much longer. And debt of this magnitude can never be paid back except through devalued currency. Listen, if you know another way, if you're one of the troll viewers who likes to watch and, hate what I'm saying, I know you're some of my most dedicated viewers. If you know a way that the U.S. national debt can be paid off without devaluing the currency, you let me know. You put it in the comments down below, because I'd love to hear what that is. But if you can't provide an answer for that, then I think you might want to consider getting some hard assets. Not financial advice. I don't give financial advice on this channel. I'm not a financial advisor. I'm just a guy on YouTube. But hard assets, when this all plays out, are going to be the place to be, if you ask me. So that's why I'm still stacking. But let me know what you think in the comments down below. Thanks for watching, everybody. Don't forget to like, comment, and subscribe. Tell your friends. Smash that like button, and I will catch you next time. Stay safe and happy stacking. Smart Silver Stacker, out.